The world was caught off guard. A single signature in Washington triggered an overnight upheaval across three economies. Scott Bessant issued a $20 billion order to stabilize Argentina's peso. Meanwhile, Australia's largest miner discreetly began accepting Chinese yuan, ending a century-long reliance on the dollar. By morning in Tokyo, the yen plummeted past 152. Trading floors erupted in chaos, while central banks remained silent. That afternoon, across the Pacific, BHP, Australia's mining powerhouse, confirmed a once unimaginable shift. Its latest iron ore shipment to China was settled entirely in RMB. The transaction was recorded on the Shanghai Clearing Bank's ledger, verified by the People's Bank of China and quietly noted by the CRA. In one night, the dollar's dominance took a significant blow. It marked the first major Australian commodity shipment priced and paid in Chinese yuan, bypassing the US dollar. Traders noted the coordinated timing. Washington bolstered the dollar in South America, while Beijing expanded yuan use in Oceania. The Wall Street Journal called it the emergence of two opposing monetary fronts. By late September, Argentina's reserves had dwindled below $1 billion, with Bloomberg reporting inflation surpassing 180% year-on-year, the highest in Latin America, based on central bank filings. President Javier Milei's administration had already scrapped several import licensing systems to secure grain shipments. Scott Bessant, justifying the U.S. swap line, claimed it was to prevent systemic fallout. However, major financial outlets questioned if this signaled a return to U.S. currency intervention. During Washington hearings, Senator Elizabeth Warren demanded transparency on who benefited when U.S. funds propped up Argentina's failing peso. She pointed to hedge fund stakes in emerging market bonds, suggesting Treasury bailouts might be shielding private investors' exits. Her remarks rippled through CNBC and MarketWatch. Traders shorted the currency, wagering Bessant lacked political support for further intervention. Meanwhile, Beijing operated discreetly. The China Daily reported that the Bank of China's Sydney branch processed record renminbi volumes in September, up 38% month-on-month. Australia's Department of Industry projected that over $45 billion in annual iron ore exports could shift to yuan pricing within 2 years if settlement barriers remained low. For China, this was less about publicity and more about shielding itself from Trump-era tariffs and dollar fluctuations. Bessant's history was relevant here. Before joining the Treasury, he managed Soros Fund's macro portfolio during the 1992 sterling crisis. Fitch Ratings held a CCC- outlook deep in junk status, but acknowledged temporary stability from unprecedented U.S. liquidity. The term extraordinary highlighted the unusual nature of this Pacific-spanning arrangement. BHP's shift to renminbi reverberated through commodity markets. The Financial Review cited unnamed Rio Tinto executives exploring pricing flexibility due to new Chinese clearing incentives for miners. An internal ANZ bank estimate, reported by Reuters on October 9th, suggested yuan denomination could cut hedging costs by up to 20%. However, this shift tethered Australian firms to Beijing's monetary cycles, a risk once deemed unthinkable. This wasn't supposed to happen, not yet. The U.S. was expected to remain the ultimate liquidity backstop, while China, despite its trade surplus, faced capital control constraints. Yet the dynamics reversed. Bessant deployed dollars to maintain influence, while Beijing exported yuan to expand its reach. On October 10th, the People's Bank of China integrated Australia into its upgraded cross-border interbank payment system, enabling instant renminbi settlements through local banks. On the same day, Japan's yen sank to its lowest level since 1990. Bloomberg Economics reported that Tokyo's Ministry of Finance had spent over 5 trillion yen, roughly $33 billion, defending the yen in the prior week, yet it still dropped 0.8%. Japan's political shift, following Fumio Kishida's resignation, hastened the decline. Sanae Takaichi, The new prime minister vowed aggressive fiscal stimulus and dismissed interest rate hikes as anti-growth dogma. The Nikkei 225 surged on stimulus expectations, but the bond market faltered, with 10-year Japanese government bond yields jumping 17 basis points in a single day, the sharpest rise since the 2016 yield curve experiment. On October 11th, IMF data revealed Japan's gross government debt at 235% of GDP, with foreign ownership of Japanese government bonds dropping to 5.7%, the lowest in 15 years. The Bank of Japan now held over half of all outstanding debt, effectively monetizing deficits. Nomura analysts warned that a yen fall below 155 could trigger a second-order effect, forcing Japanese insurers to sell U.S. treasuries to offset foreign exchange losses. In Washington, Bessant sharpened his rhetoric. Speaking on CNBC, he declared that the dollar's credibility hinges not on words but on decisive action. He framed swap lines as reciprocal confidence tools, not bailouts. Yet Bloomberg calculations showed the Treasury's exposure through these lines had surged to over $65 billion across emerging markets, up from $12 billion the previous year. Australia's Reserve Bank responded cautiously. In a briefing cited by the Australian Financial Review, officials described RMB settlements as commercial choices, but recognized that currency diversification could mitigate systemic dollar risks. Off the record, several former RBA governors told reporters the shift was inevitable once China dominated both demand and payment infrastructure. By October, China's Ministry of Commerce confirmed that 18 countries had signed partial trade deals in RMB, up from 11 in 2023. A leaked U.S. Treasury memo, reported by Politico, warned that de-dollarization was outpacing projections. The paradox became evident. Each dollar Bessant injected overseas reinforced the perception that alternatives were necessary. Defending the dollar exposed its vulnerability. Japan's woes intensified. The yen's decline briefly boosted automaker margins by making exports cheaper, but it spiked energy import costs. LNG contracts tied to the dollar rose 12% in yen terms within a month, and household electricity bills surged 15%, the fastest increase since 2014. Local media dubbed this imported inflation. The Financial Times quoted former BOJ official Kazuo Ueda, who warned that the government's fiscal stimulus and the bank's yield control were unsustainable. Prime Minister Takaichi brushed off such concerns, defending the weak yen as a vital buffer against foreign tariffs. Australia's Treasury quietly adjusted its foreign exchange reserves, with Bloomberg data showing the share of RMB assets rising from 6% to 9% in Q3 2025, the largest quarterly increase on record. In Argentina, Bessant's intervention temporarily reduced monthly inflation to 9%, but the relief appeared fragile. In London, futures traders began pricing yuan-denominated iron ore contracts at a discount to dollar-based ones, signaling growing confidence in RMB liquidity. Within the White House, aides debated whether Bessant's actions contradicted Trump's campaign promise against taxpayer-funded foreign rescues. A Treasury spokesperson maintained that all operations were fully collateralized. Congressional critics raised concerns about the transparency of U.S. Treasury actions. China's state-run Xinhua published a sharp headline. U.S. Treasury prints. Confidence, not stability, asserting that Beijing's currency diplomacy had surpassed Washington's coercive tactics. In Sydney, BHP's shares rose 3.8% following the RMB announcement, as investors saw China-linked contracts ensuring long-term revenue stability. The Australian Financial Review dubbed it a new financial geography, shifting from London to Shanghai. Meanwhile, Japan's Ministry of Finance faced a dire situation, burning through $40 billion in reserves over 2 weeks to prop up the yen through emergency U.S. dollar purchases. The Wall Street Journal cautioned that Japan's self-financing illusion risked unraveling if confidence collapsed. Even the IMF joined the debate. Now, if you like this video, check out this next video right here.